Hi and welcome to Random Rogers Big Picture for the week of April 12th, 2009. I'm going to try and get to a couple of reader questions today. Hopefully I'm not too long-winded and have the time. So first, someone asks, it's kind of a long comment, but asks to clarify what I and quote-unquote the industry define as a bear market rally versus a bull market. The market's up 28%, which is more than the normal 20% move usually identified with a bull-bear move. So is it a bull market? And then there's more stuff here, but I'll stop there reading. I have always, it doesn't come up that often, so it's be tough to find in the archives, but I've always kind of shied away from trying to proclaim, a 20% move as being a new bull or a new bear. It's not enough information. You need to know more than that. For example, in 97, there was the Asian contagion. In 98, there was the long-term capital implosion / Russia defaulting on its debt. In both of those instances, I don't recall, I'm pretty sure in 98 the market went down about 20%, but those were fast declines, whatever the magnitude, and go look on the chart, go to big charts and look for yourselves. But those declines were very, very fast. They were crashes of sorts. Not like 1987, but they were just unbelievably fast declines. And typically, when something goes like that, very fast, it goes like this. It retraces very quickly. And so if the market were to crash 25% tomorrow on some sort of news, whatever the news might be, and make it back 6 weeks later, the way I think of things, that's not really a bear market. It's a great chance to get shaken out of a lot of things, either in terms of stop orders or just succumbing to some sort of emotional fear. But fast panics, regardless of the magnitude, to me are not bear markets. What we've had on this go-around, and something that has repeated over and over, and so this is why I was on the lookout for it and writing about it so much, is kind of the slow rolling over of the market. Low single-digit declines 3 months in a row. Ken Fisher wrote this up as the 2% rule. I don't know if it's exactly 2% for 3 months in a row, and that type of precision doesn't mean much to me. But small declines 3 months in a row, that's typically how bear markets start. They don't start with a loud bell ringing like a $1 billion or $2 billion hedge fund controlling $100 billion worth of stuff wiping out, or the Asian contagion, or Russia defaulting on its debt. Those types of things are not what cause true bear markets. They cause panics, and panics tend to resolve quickly. So I don't know if the reader is going to like that answer, but okay, fast forward, back to today. We've got an enormous rally. Another reader left a comment about this being the biggest move since 1933 for 1 month. I don't know if that's true, but it's obviously close. We all know that this is about the biggest move ever, certainly in a long time. Another reader left an interesting comment about 1982, about how quickly that one came back. It came back very quick, not quite as quick as the 20% we've had in 1 month. That, to me, is a buying panic. And so, that's, to my way of thinking, it is not the start of a new bull market. However, as I said in the blog post on Friday, I don't have to be right about that. I'm more in than I'm not. I've been more in than not this whole way through, for the exact reason of not having to be right about something. This is difficult stuff. I'm convinced it's a bear market rally or a feel-good rally. There's no convincing me otherwise until I'm wrong. However, if I am wrong, I'm positioned in such a way where it doesn't mean a whole lot, and that is crucial to understand. If I do nothing, I will lag, but I won't miss, and that is what I've been saying over and over. You only get so many of these moves in your lifetime, assuming it's the real thing for a second, and you just can't afford to miss them. In my thing on CNBC on, I guess it was Thursday, I made the point about, and used 2003 as an example. The way bear markets work, the returns are not evenly distributed. You're going to get a big move, a big chunk of the bull, all at once. And that was the case with 2003. You had a tough time. If you missed that first 26% off the bottom in 2003, you had a tough time keeping up with the rest of the bear market. You made the task much more difficult. Let's put it that way. Then another reader, I'm going to change now to the next question. Another reader asked me to clarify my thoughts on Australia. He is apparently from Australia. He says he's from down under, so I'm assuming that's Australia, though maybe it's New Zealand. Australia has a couple of problems that are frankly not as serious as the U.S. They don't have subprime mortgages there. They do have a reliance on Japan. Japan, hi, how you doing? They have a reliance on China, which bears understanding, and I think just about everybody, if you care enough about investing to come to a site like this, you already know this. They sell a lot of stuff to China, a lot of resources. China, maybe a little further beneath the surface, is devoting a lot of money to trying to buy stuff in China. Like, I believe they went after Fortescue. I believe they went after Oz Minerals. A couple of other things. Rio Tinto. I might be wrong about the Fortescue, but Rio Tinto, Chinalco is trying to buy a stake. Minmetals is trying to buy some or all, depending on the latest headline, of Oz. Is it Oz Minerals or Oz Metals? But whatever. But it is a heavily brokered market. There's aside from the material sector, there is a big financial sector. Someone way back at the beginning of the blog, so it's like 2004, left a comment about Australia being the most over-brokered country in the planet. That I can recite it to you now off the top of my head tells you that it stuck with me. There are a lot of banks, there are a lot of insurance companies, there are a lot of other, transaction-oriented, thus relying on finance as part of the index. And so there have been a lot of blow-ups. Macquarie's funds have struggled, a lot of the ones there. Babcock and Brown was a big investment bank. I don't know that it's gone, but it was trading for a few pennies. They've had a lot of problems. It is not as bad, in my opinion, as the U.S., but the point being is that even if they continue to sell a lot of stuff to China, and China is clearly enduring its own cyclicality, but to the extent that they are selling to China, that helps. But I think it's going to be a while. They've got they're heavily dependent on the housing market. The housing market had a big run up. Not as dependent, I don't believe, as the U.S. That is just opinion, though, and easily refuted. But there's a lot of moving parts still to the broad average, and so it makes picking a stock there maybe a little tougher to do. It is kind of complicated, but it is less complicated than the U.S. Hopefully I'm saying that in a way that makes sense. But those are all little nuggets that you can go look at for yourself. All right. So as I mentioned on Friday, I'm on this Twitter now, twitter.com/randomroger. Hopefully you can check it out. Have a good weekend.